Hello, folks. Brandon Chapman today. It's a Monday video for TheoTrade. It's January 6th, 2025. And hard to believe we're in the year 2025. But anyway, let's get going. The ES today was higher, 0.62%. We look at the SPY at 0.58%. If we look at the cash session today, you'll see a rather, ignominious candle, right? It's basically the open and close are virtually identical. The range on the candle, we have a longer upper shadow and a long lower shadow. It's basically just a spinning top. What does this represent? It represents an indecision day. But when you look over here, you'll notice virtually all the market sectors were underperforming the S&P 500, with basically about 6 different sectors in negative territory, with real estate bringing up the tail end here of the train down 1.37%. Does look like it's poised to break out to the downside, which we'll talk about in just a minute. But when you look at technology and communications leading the way, you know one thing. This is about the Magnificent Seven, right? At TheoTrade, we call them the monsters of tech for many years. But the idea is these companies represent a significant percentage of the S&P 500. In fact, they represent a significant percentage of the returns in the S&P 500. Amassing about 60% of the S&P 500 returns in 2024 were a result of these 7 companies: Google, Amazon, Apple, Microsoft, Tesla, Meta in there as well, NVIDIA. So the point being is that what? These companies lead the way in the market. They are the largest market cap companies in the world. And so as a function, they're going to lead the market higher and lower most of the time. So what does this mean for you? It probably means you need to hold some representation of these companies. Again, you'll look over here, the S&P 100, the best performers today. Who's among them? Meta, NVIDIA. You look Google, Amazon. You just go down the list. Again, if the market's going to be higher, you probably want to own some representation of these companies. And if you look at hedge fund managers, look at their holdings, not just their top holdings, their holdings. They hold significant percentage of these companies. And these guys are supposed to make money in any type of market, right? Well, that's not necessarily true, but a lot of these guys do very well and have done for a very, very long time. And again, what are they holding? They're holding some smattering of these companies over here that are leading the way on the left, these Magnificent Seven companies. So what does that mean for you? It probably means if you're bullish on the market, you probably should own some representation of the Magnificent Seven of stocks, and not in a bundle like the SPY. Because on a day like today, technology being led by these kind of these technology companies, communications companies, they're outperforming the S&P 500. They outperformed last year. So the point is that, look, I've been looking for a 5 to 10% correction. We looked at it back here on the 29th. We got it from peak to trough, about a 5%. We ramped up very, very quickly on the 24th of December. Again, off the high, we're looking at a 5 to 10% correction again. We made it about 3.5%, and we've been up the last couple of days. But does this mean that these companies are going to be able to carry the weight of the market going forward higher, while the market, generally speaking, is waiting in the abyss? Not exactly, and you see that today. But it still makes sense to hold those companies, even if you expect the market's going to decline 5 to 10% from here. That is a correction after all. It's not a bear market. So are we on the verge of a bear market? I don't know. And frankly, I don't really care. But the idea is we need to find some companies maybe outside of the Mag 7, but the idea is you may be holding some complement of the Magnificent Seven in the interim, right? As you're looking for other rotation among these opportunities. And one of the areas I've been pretty bullish on of late is energy, off of the lows down here. In particular, companies like CVX, right? Chevron. It's a company where, again, you can buy the stock, use the dividend to buy a put. We talked about here buying 140 puts, maybe even a 135. But the idea is you can hedge your downside. Same play we did back here in October off the breakout here in the first. Use the dividend to buy puts. Let's look at 165 and take it off, which we did back in the end of November. Reset again. We're looking at the upside here. Oil inventories, very, very low. And so the idea is that there are opportunities that exist in the market today outside of the names that are just leading today. And on an indecision day, if the market goes down tomorrow, these companies are likely going to be, most of them of the Mag 7 are going to be down. Maybe an NVIDIA stands out because semiconductors have been holding up well, but NVIDIA's back to prior highs. Maybe it's Apple this time that's been lagging a little bit over the last week. Maybe Apple takes its turn leading the way. And again, it's just this rotation amongst these companies over here. And again, they've contributed to most of the performance in the S&P 500, 60% of the performance of the S&P 500 in 2024. So again, the point isn't to spend a lot of time looking at those stocks. Again, pick which ones you like and maybe you own them as long as you feel constructive on the market. Now, as I look at the market, are the downside risks still relevant? Yes. Are we at the 5 to 10% pullback? Not exactly yet. And today really is illustrative of that. However, let's look at the VIX today. The VIX didn't really move a whole lot. The market was up a 0.5%, 0.6%. The VIX really didn't sell off here. The VIX really didn't spike up here either. This is what I call delta comfortable, meaning that institutions that use options on the SPX and the VIX, et cetera, to hedge their portfolio, they already had a pretty significant hedging event back on the 18th of December. They're probably relatively comfortable. And all we got to do is look at skew and say, hey, we're fairly elevated here at 157. We're north of 130. So there's a lot of hedging that's gone on here, which means what? It's going to take a little bit more this time in terms of downside to cause the VIX to pop here. But today's move did not come as a result of VIX selling, which means that the 3-month VIX did not surge relative to the 1 month. In fact, they stayed roughly the same, and we never achieved this. But conversely, we never saw this ratio get down here below 1 to mark a significant low like we saw on the 18th as a buying opportunity in the near term. And so as we look at the market, risks still remain to the downside. But what if we don't realize the downside? What if we continue to grind? Maybe there's other aspects that come out here and we never reach that extreme. That's why you're holding these companies. But we're also looking for stuff that may perform regardless of what the market may do, both bullishly and bearishly. So I got a couple of ideas for you to review here. Now we're going to have a chance to look through all of these, but you'll notice there's a few areas that stand out. First is energy, CVX and APA. What is this? These are option pulses. They're basically trades that are going on in the option market of size that are indicative of direction. Basically in CVX and APA today, they're buying calls. Well, we just looked at CVX. What about APA? Well, let's take a look at APA. So as we look at APA here, again, this is one that last week I reviewed as an opportunity and a space we've been bullish on. I've been bullish on it in energy. Oil inventories are near the 5-year low. We're scraping the bottom of the barrel, and oil's been holding up really, really well at around that kind of 66 level down here. And we had a breakout last week. Are oil prices on the verge of making a big rally here? I don't know. And it doesn't necessarily really matter if oil prices at least hold this area. These companies should be coming off because there was a whole lot of pricing going on into the end of last year that suggested, right, that oil prices were going to continue lower. And that's probably not the case here. And I kind of drew a seed wave projecting we may get a chance to go into 28. Well, guess what? We're still in the seed wave today with the high at 2450. So we're looking at 28, maybe upwards of 33 over the course of the next weeks to months on Apache. Well, let's go back. Let's look at semiconductors. Well, one semiconductor stock, and also there's a companion trade with MU or Micron, but Western Digital, 10 Jan 25, 71 calls being bought. And so we look at WDC here. Again, are we seeing strength in semis? Yes, we are in the last several days. Is this a little bit overbought? Yeah, you might look for a little pullback. Could we retest 6240? Sure. This is a shooting star, long upper shadow, smallish body at the lower end of the range. You might look for a pullback, maybe closing the gap to 64, but it does create an opportunity for out of the money call spreads. And we can see in here, do we have the type of skew? Yes, it's just okay, right? It's flattish in here. So you could buy a 67.50 and sell a 70. Market pulls back a little bit. You could buy a 65, sell a 67.50. You could construct a reasonably priced spread in WDC, just looking for upside to 67.50, maybe 70, depending on if we pull back and you enter or we start to break out. But ultimately, we may have a chance of getting back to 74 in WDC. We look at material stocks. There was trading Cliffs today, CLF, AA, Alcoa, US Steel, Century Aluminum, CENX. It was a roll that out of the money of the 19 call again. I picked these two just because of their short interest. They have higher short interest and the potential that we could get a gamma squeeze to a short squeeze. What does that mean? They're buying options that are forcing the market makers to hedge. And if you look intraday today, you'll see some of these moves in here, like in Century Aluminum or in Alcoa, for example. Right here, there was some option trades that came in 924. We saw a big spike in the price. Again, these trades are moving the market in these stocks. And as I look at these, and again, I'm looking at the higher short interest stocks, like, for example, CLF. That saw some trade today. Again, on CLF, it was the 29 Jan 11 calls being bought. And so again, we look here, well, what's the upside? 11? That's about a 50% retracement of the sell-off here. Again, that's not a bad move. You could buy at 10 and sell an 11, buy at 10 or sell at 12 for February. Again, these create, again, opportunities. There's a lot of stuff to sell out here. Notice the volatility is significantly higher than it is at 10. So again, you're buying low vol, you're selling high vol. Those are the combinations we like to look for. CENX, not as much liquidity in CNX. So again, what could you do with CENX? You could look at Century Aluminum, just playing the upside move here and just trading the stock. 20.5 to maybe 22 would be the near-term upside. We break this area, we're going back to 25, but a 22 handle still represents almost a 20% move off its current level, and you're getting out if you break support down here. Okay, now we go back for solar. So now we're looking at other stocks, again, clean energy companies like First Solar, Albemarle. There was a bunch of other stocks, but generally I classify these companies as high short interest companies. QuantumScape as well, breaking out today. You could buy a 7 call, sell an 8, or even sell a 9 out here for February. So again, you get the upside there. But again, we look at First Solar. It is a solar company, obviously broke out past the prior high. We did fade a little bit here. We might pull back slightly, but if we can form a higher low, again, where could this potentially go? Again, if we kind of take this as the seed wave here, we could project out 214, right? We could look at the down move here. Again, measure the retracement. What is that? 50% retracement is about 218. We could reasonably look at maybe a near-term pullback, but a run to maybe that 220 area. And again, you come out here to February, you can buy, again, $5 increments on the strike prices, but a 200, 210 jumps to $10, but a 195, 200. The vol skew is not super favorable. We're a little after hours here, obviously, with the bid-ask spreads doing some funky things. But the idea is upside in First Solar, we may have a chance to get back to 260 or even 300 with First Solar. And again, it could be a decent stock trade, again, with an exit on a break below 175. But again, we look at Albemarle, LB, right? So again, this is a minor. We're looking at a bounce day. We did fade, producing that kind of shooting star type formation. Shadows a little longer down here. But again, this may be the beginning of a bigger move in Albemarle. We're just looking at what? Retracing maybe a third to 2/3 of this down move. That gets you to 95, maybe 102, and we're currently at 90. So again, potentially 10% of upside. You can risk $5, or you could also look at trading some spreads in here. But again, it's a $90 stock. We've got $5 increments. So again, could you buy the 95, sell on 100? Not much difference here in vol. Again, you just need to go north of 100. Maybe look to pick up, about 60, 70% of return on that spread and close it out. But these stocks, if they get the short squeeze, could move big. RIOT's another one. I know I got a big list today, but RIOT, we're seeing a nice break here last week. I looked at a trade, Mara. I generally like Mara better than RIOT in terms of it's more oversold. We're looking at, again, a 2022. You can maybe ratchet up to a 21.23 today with today's $1 move, but looking for Mara and RIOT to move higher. But RIOT today, it was the 1450 calls, which again, we're looking at retesting prior highs here with the current price at 13. On the bearish side, we're looking at IYR. So IYR today, what we have right now looks like a flag type pattern, right? Equal highs in here, higher lows. Again, we see the down move here, pretty substantial. and you start to project, you break through this 138 to 161, we could readily see an 82 to 85 target range for IYR. Now, has it broken out yet? The answer is no. We saw a down move today. We've not yet taken out the low or the high, but again, given the downside here, we're expecting to see a downside breakout. And with today's trade in IYR, it is a March expiration in here, and we're looking at downside option activity. They bought the 88, sold the 83. That's a big move at 83, retesting lows. You don't have to be that pessimistic on it. You could go closer, stick with maybe like a February expiration, and spreads have widened out here after hours, but plenty of depth in these markets. Buying 91, selling 89, buying 82, selling 90. So the idea is you can construct any spread you want and look at the downside potential here on a break. You get a move to 90 to 89, you're out, probably for a 60 to 70% gain on that spread. And another one, carrier. So this again tied to the real estate space, building, etc. Very similar pattern forming here. Again, looks like today we may be forming some degree of resistance if we break support in carrier. This is a March expiration down here. We're looking at they bought the 65 puts, sold a little higher quantity of the 5750s. And as you look at the option time and sales, again, we'll look at puts and we'll focus on the March expiration. You'll see it was basically done all at one time, got filled in 3 different trades. But again, buying the higher strike, selling the lower strike. This is a pretty big downside projection here for carrier. And so again, with the treasury yields rising right now, borrowing costs continue to look higher. Again, weaker dollar today. We may see further upside here, which is going to place pressure on real estate type companies. Anyway, so again, those are some opportunities that no matter what the market may do, there may be an opportunity in these companies going bullish and bearish. And it's like whack-a-mole. One pops their head up, you close it out for 60 to 70% gain, right? Market continues higher, close out the bullish side. Market continues lower, you close out the bearish side. And maybe since we have about 45 days here, we might see a short sell-off in the market, and we may go head right back higher, or vice versa. We may head higher and then go lower. And it's the idea is you're placing very well calculated spreads around maybe some of your Mag 7 positions to help build out a portfolio of spreads and stock that may weather to some degree the market's violent potential volatility that we see here, or the lack of volatility as we just grind higher. Either way, in your pretty good position. Well, folks, we'll wrap it up there. We'll catch you back on the video for next